Well, I am definitely looking forward to this topic because I helped kind of help you put the slides together, and I've already gone through the material a little bit and kind of know where this is headed. So I'm really excited for everybody who's joining us and who will be joining us. And it is at that time, it is 1 o'clock. So I don't want to hold back too much from anybody else. And so let's do a few introductions first before we dive into it. And so most of you who have been on our prior webinars know a little bit about myself. My wife and I have a podcast called Tough Decisions for Entrepreneurs. And on that podcast, we interview entrepreneurs that, have that share their story about how they have tough decisions or they face tough decisions along their journey of success. And we dive into some of the lessons that they learned or some of the lessons that they have learned through that and how they make better decisions. And so we dive into the difficult topics of decisions gone wrong, but also decisions that have been done really well for them. And so we kind of have a balance there. And I would love for you to go to our website, toughdecisions.net, and subscribe to our podcast either on our website, or you can do that by pulling up any of your major podcasting platforms. We're on iTunes, we're on the Google Play and all that other kind of good stuff. So we're on so many of them I can't even list them all. But if you listen to podcasts, I would really encourage you to listen to this podcast. And I bring this up and talk to you about this because instead of me spending time talking about my background and my story, I would encourage you to go to our toughdecisions.net. On the very top of the page there is a link that says Our Story. And my wife and I go through and talk about our backgrounds as entrepreneurs and business owners and now real estate investors and how we've gotten to each stage that we have had and the success that we've had. And so we talk about some of the bad stuff and the good stuff and then everything in between. So I encourage you to go do that. And I'm going to turn it over to Jonathan to talk a little bit about your background and where you've been and where you're from and kind of fill in some of the gaps. We got a few more people joining us.
Absolutely. Well, thanks for having me, Dan. I really appreciate it. I had you on my podcast the other day, and it was great to get to know you there. We'll get to know each other a little better on this call too. But in terms of my background, I started out in a very different field, like most people, I think, who come into real estate investing. I was a corporate lawyer here in New York City. I worked on Wall Street for about 12 years. I loved the first 2.5 or so years of it, and the rest of those 12 years were like a rainy Monday morning every single day. And the great benefit of working as a lawyer in New York City was that you didn't just get to have rainy Monday mornings Monday through Friday, but you got to have them pretty much Monday through Sunday too. So I was pretty unhappy in that job and looking for ways to get out and tried a couple of false starts on stuff. But my big break came actually when I got laid off from that job in 2011. It was kind of a belated casualty of the Great Recession when the litigation work just kind of dried up. People were so afraid to spend money on anything that they didn't even want to pay money to fight with each other, which was a big difference from what had happened before, in the dot-com bust when that blew up. I mean, there was so much litigation, kept us very, very busy through that recession. But we were all expecting that in the Great Recession, and it didn't happen. And so I found myself without a job suddenly, which is a new feeling for me. And I was really burned out though from the law job, and it was already at the stage where I just really didn't want to pursue it any further. And it felt like, how am I going to convince somebody to hire me for a job that I don't want? That was kind of the position I was in. So but I had some money saved up. I talked over with my wife, and she kind of gave me permission to try to pursue something else. Just so happened that right around that time, I had been doing a lot of I'd been doing a lot of networking with people trying to figure out how I might possibly break into real estate. And my original thought, just having come from a corporate background, I didn't really ever envision like, hey, I'm going to go do this on my own. I thought like, hey, I'm going to go join some big company and become an analyst or do something for a big company. And I was doing a lot of networking in the city, trying to see if I could break in. And I was running into like two major problems with that. One is that, there were like 10,000 people who'd just been laid off in that industry who had resumes the length of my arm, who weren't trying to switch from law to get into that field. that I was competing against. And the other thing was my age. And I just kept on running into people saying the same thing, like, hey, you've got this great resume, but basically, at your age, you can pretty much forget it. And I was told by an older, wiser person in the field, like, hey, really, the only way you're going to break into this business is if somebody decides to partner with you and just, takes a liking to you and says, hey, partner up with me. And then exactly that thing happened. In the course of my networking, somebody said, hey, look, I'm starting up this real estate investment business. How'd you like to be my partner? And I thought, that's interesting. I wasn't sure what I should do at first, but I went and talked to a couple of people that I really trust. And they both said, well, hey, let me meet this person. So I introduced this potential partner to both of those sort of trusted friends. And they both wound up saying the same thing, which was, hey, if you decide to do this, I will give you money to invest. And I figured, maybe I should take a chance on this. Maybe this is something that I ought to do. I had, the partnership offer on the one hand, I had the investor money offered to me on the other hand. And I thought, let's go for this. As soon as I joined up, I was in for like the next surprise, which I just assume, since I live here in New York City and everybody here is consumed, they're sort of overwhelmed or obsessed with like buying brownstones ahead of gentrification. I sort of assumed that that's what we were going to do. And my partner was like, no, we're not doing that. We're going to buy 100-unit apartment buildings in Louisiana and we're going to syndicate them. And I was like, what? But to make a long story short, I kind of, she had been through one of those guru programs and she gave me all the materials and I listened to it all and kind of got an idea of what this was all about. And then we just dove into it. We started looking for deals. We got some deals under contract. To make a long story short, we never actually closed any deals. It was kind of a bad lending environment and we were new and the banks were skittish and we weren't able to close a deal at that time and then ultimately wound up the partnership. But when I was then trying to figure out what to do after we wound up that partnership, one of those original two friends said to me, hey, Jonathan, we had dinner one night and I was like, what am I going to do? I think I might have to go back to practicing law. And he said, don't be so hasty. Why don't you and I partner up? I'll back you. You do the business. I'll just stay in the background. And that's how I got started. So I founded my company, Two Bridges Asset Management, in 2013. And, after the usual kind of like difficulty in getting these things starting up and getting traction, we very quickly ramped up to, 400 units or so down in South Carolina, down in your neck of the woods. And we've been, running those assets ever since. So that's kind of like the general background story. I don't know if you want to know any more, but that's pretty much it, and as quickly as I can tell it.
Yeah, no, that's great. I hadn't heard that background story yet. And so it was, I'm glad to be able to kind of now put all the pieces of the puzzle together to kind of figure out, where your knowledge base comes from. And I know that you have an asset here in my neck of the woods. I'm in Columbia, South Carolina, but you have one in Greenville, right?
We've got actually everything that we own is down in Greenville and Spartanburg.
Okay, awesome.
So
awesome.
Yeah, it's a great market. I love that market some other time, maybe we can get into it for the listeners. I'm sure but I love that area because of the demographic story that's going on there. And just, certainly compared to New York, the cheaper assets, although I think the market's pretty high priced now, but
yeah,
when we got in.
And you might not have known this, Jonathan, but I just locked up a deal in Greenville, South Carolina. It's a 130 unit one right out there off of Wade Hampton Boulevard. And I'll talk to you a little bit about it more too, because it's actually a really good deal. You probably have seen it if you've done any research down there.
If it's what I'm thinking of, it's probably down the street from one that we own.
Yeah. Well, let's connect afterwards and talk about that a little bit, because I didn't realize you had all of yours down. I know you had at least one. Somebody had told me that. I think maybe you mentioned you had some properties down there, but that's great. That's where I grew up. So I drove by this property for 25 years. Growing up.
Nice.
All right, so let's dive straight into the material here. So we've done our introductions. We've got lots of people joining us on Facebook as well as on our Zoom platform. And as I'll tell you right now, if you're on the Facebook platform, as Jonathan is going through the material here, I want you to write down your questions. And then at the end, I'll have you post them as a comment on Facebook. But if you are on our Zoom platform, there is a little bar that says Q&A. And on that bar, you'll in that Q&A section is where you'll start to add your questions as we're going throughout the material. And that way you don't have to worry about writing them down. So make sure that you dive in with lots of questions. Obviously, when you go through this kind of material, you're going to have a lot of your questions already answered in the material as we move forward, because it'll create a lot of questions, and then he will clear that up with answering some of those questions with the future slides. So sometimes it's better just to everybody write down their questions and hold them to the very end. So John, I'm going to turn it over to you and have you start diving into the topic we're going to get started with, which is the various stages in market cycles.
Okay, cool. I just, before we jump in, I just see that my student and now friend Joe Eli is on the webinar, so I just want to give him a shout out. He's down in your neck of the woods too. But anyway, hey Joe, sorry. So we're gonna talk about two sort of different things in this webinar. One is market cycles, then we're going to talk about their relationship to investor psychology. So Dan and I were joking beforehand that maybe we should have called this presentation Market Psychology with a CY rather than a PSY, because it's kind of combining the two. But let's just jump into kind of a brief overview of market cycles so that you understand how these work. And I'm going to ask Dan if you could advance the slide to get to the next slide here. So this is a basic overview of the real estate cycle. And this was discovered by a professor of economics named Glenn Mueller. And I highly recommend that you follow him. If you Google him, you can find an outfit that he advises that puts out this report every quarter. You can subscribe for $1,000 a year and get the most recent one, or you can get it 1 quarter behind for free just by downloading off their website. I think it's a very helpful resource, and doesn't cover just apartments, covers all commercial real estate. But the thing to understand about market cycles is it goes through 4 quadrants, and really what determines where you are in the market cycle is this long-term occupancy average. If you see that dotted line that goes across the cycle, that's your long-term occupancy average. And you really have to understand real estate in relationship to this long-term occupancy average. Now let's just pick a number. I don't know exactly what it is really long-term, but in terms of an underwriting standard, we'll typically use 95%. So just for the purposes of argument here, let's just imagine that this line is your 95% average occupancy. And you see that the cycle starts at point 1, diamond 1. This is phase 1's recovery. Feels a little bit odd to start here, but in a sense that this phase is when nothing is happening. So this is the bottom of the cycle, and you travel up through expansion into hypersupply and then finally into recession. And let me explain what each of those is. So you kind of have to understand where point 1, you have to actually kind of put yourself back at the other point 1 over here on the right with phase 4. It's the same diamond, just so I understand. This is the point where you've just had basically a crash in the real estate market, right? So the market has bottomed out at this point, and you're at the absolute bottom. And what that means, the bottom means you're at the cyclical low, so the low point in this cycle for occupancy, right? So vacancy is at the highest point that it will be in the entire cycle. And the reason that it has reached this point is because you have had overbuilding in the previous cycle, and you haven't had enough economic growth or enough household growth to absorb those apartments. So that's the bottom point. Now, at point 1, there's no new construction going on at all, right? You've cycled through all the construction from the previous cycle, and nobody's building anything new because banks won't lend. They see what the environment is like. Their banks are always reactive. They're not forward-looking. They're not thinking like, hey, we're at the bottom, we should start lending to get ahead of the next cycle. They're saying, oh, it's too scary, we're not going to lend on anything. So all construction basically grinds to a halt at this point. And then what happens is you have natural population growth, and maybe you start having some economic growth, and the demand for apartments starts to grow. So start traveling up this cycle to points 2, 3, 4, 5 until you finally hit point 6, where you're at 6, which is back at the long-term average, right? Now, when market players see this happening, that's when they feel safe to jump in, and banks start to lend again, and you start having new construction. Right? Maybe some of the early players have gotten ahead of this at 3, 4, 5, but really when you hit this long-term average is when you start to see this accelerate. And so what happens is construction starts, but because the lag time for construction is such a long time, right? Units are not really going to get delivered until probably in phase 3, right? But what's happening throughout phase 2 is you've got, economic growth and population growth continuing, and your occupancy now crosses this long-term occupancy average, and you get into very, very high occupancy. And the reason this is happening, even though you've got all this construction coming online, is because the construction lag time, it just takes a long time to get there. So over time, you get those two things sort of coming together till you hit point 11, where the number of new units coming onto the market is equal to the new demand for units, right? And at that point, you hit equilibrium, right? After that, what happens is there's demand for apartments is still happening, but all of those units that got started under construction in phase 1 and phase 2 are all coming online in phase 3, pretty much all at once. And as a result, now you have a glut of apartments on the market, and your occupancy starts to tick back down to the long-term occupancy average, right? So you have increasing vacancy, but new construction still coming online, right? And then that process just continues as completions continue to roll out, and when occupancy starts dropping below this long-term average, then you're into the fourth phase, recession. This is when everybody starts getting skittish. The banks stop lending. There's no new construction. New developers don't want to take the risk of building new construction, so they may actually halt progress, sort of halt developments that are permitted. They may just sit on them because they don't want to expend the construction cost at this point, and things sort of grind to a halt, and then you wind up back at phase 1. So that's the overview of the market. Now, can we have the next slide? So this is a little bit more detail of what happens during the cycle. And as you see here, in phase 1, this talks about how, like, rent growth, what happens with rent growth. And you see that rent growth, like, through phase 1, it may even be negative, right? In phase 4, at the end of phase 4 and the beginning of phase 1, you may actually have negative rent growth, which means that the existing owners are cutting rents in order to fill up their units because there's too much supply in the market. And when that process stops, when you start having some rent growth, but it's below inflation here at 3, 4, 5, 6, that's when you start to have some growth. And then you start getting accelerating rent growth as the market gets tighter and tighter, and you work up towards that demand-supply equilibrium point. Now, one of the things that Dr. Mueller talks about that's very important to note is what happens in phase 3. In phase 3, you're actually tipped over the edge, right? But you still have rent growth. And because of that phenomenon, because you're actually adding supply, but you still have rent growth is decelerating, right? So you may still have rent growth, but instead of growing like 5 points a year, maybe you're growing 2, 3 points a year instead, and you're trending down. People miss the top of the market because they see that rent growth is still there, right? And for people who have a vested interest in saying that the market is still growing, they're going to point to the fact that you still have rent growth. But the key is to watch the rate of it. The rate of rent growth is really the key point here. So when you see the rate of rent growth start to tick down, you've actually passed that equilibrium point. And then once you cross point 14, then you're into negative rent growth. This is when you see a lot of concessions being offered. You see, free rent being given away, free toasters, whatever it is to get people into apartments. And then I just want to make a quick note on kind of where, we'll get into that, in a moment when we get into investor psychology. So,
well, one thing I wanted to add here, yeah, Jonathan, if I may, is as we're going through these various stages in market cycles, you need to understand that these different stages are not going to be the same for every market. Meaning you can't say the United States is in this type of a market, these type of stages. these are very like hyper local. Would you agree, Jonathan?
Well, I'd agree to an extent, which is to say that, yeah, the different markets are in different points on this, as you go through. But I think what you won't find is like a lot of markets in phase 3, but some markets in phase 1, right? Because a lot of what's driving this is the supply of money. And the supply of money is fungible, money is everywhere. So you may have some lag, but if you have money like flooding the system, you're going to have some consistency. And well, actually, when we get to a future slide, you're going to see where Dr. Mueller places the major markets on this graph, and you'll see it's pretty similar, right? So there may be some slight differentiation at points on the cycle, but it's you have to think about the market being a national market now with some regional variations, and I think that's a new thing too. I think that there used to be more variation in the markets, even though they generally trended together. What's happened in the last few years is that, because of so much foreign money flooding into the United States, it has chased a lot of regional players into other markets around the country, and it's kind of made the market national. And there may be some lag, like I said. No, it's not like the whole country is at exactly the same point, because all construction, as you said, is local, and there are local demand and supply forces at work. But I think that there's probably less variation than there used to be. And I think you won't find really wide gaps, right? You won't find, because just it's so much easier to get information now than it used to be about the market. Okay, so how do you know which stage of the market you're in? So let's go over to the next stage. So I like to hack stuff. I mean, this is difficult data to come across. Like this is stuff that you could probably derive for your own market by looking at building permits and trying to figure out what's coming down the pipeline and what the absorption rate is. And you probably really need to talk to your broker friends about what these absorption rates are. There are also subscription services that you can subscribe to that will have a lot of this information, like Reese and CoStar. Try to stay on this data, or you can just go get Dr. Mueller's data to see. The only problem with his data is that he only follows the top 52 markets or 54 markets around the country. So if you're investing in smaller markets, then you won't. This may not be so helpful for you, but it'll give you an idea. And so one of the things is just we're just talking about that question of where about markets being in different phases. If you look at this graph here, now we've been going through, this is like 10 years into this expansion that we've had in the multifamily market. And as you see, every single market is either at the peak, which is number 11, or past it right now. So this is kind of like, you can see that some of these markets are at the peak and they're holding there. And there's one thing to note too about this is that depending on the supply demand characteristics, markets can actually move. This isn't a one-way street, this market cycle. Markets can actually move backwards on this as well, depending on, like you could have something that's in hyper supply, one of these markets at 12 or 13. And if construction suddenly stops in that market, but they're continuing to have economic growth, they could actually go back along this cycle. I'm not sure I would count on that as an investment strategy to say hey, it might go backwards, so I'm going to take the plunge. But just so you know, this isn't like an inexorable movement. And a lot of the market has been hanging around this kind of 0.11 for a long time. And some of these markets, if you go back and download multiple months, so multiple quarters of this data, you can see some of these markets sort of going back and forth between 11, 12, and 13. I haven't seen any go back to 9 or 10, but I've seen some that were in 12 or 13 go back to 11. But anyway, we're around the peak or past the peak pretty much everywhere based on these supply-demand dynamics. Any questions on this?
Does Mueller go into the smaller markets as well, or is it primarily just those 52 larger ones?
Yeah, this is really sort of institutionally focused, right?
Yeah.
So we're looking at the biggest markets. But I would suspect, though, that there's probably some regional variation here, or even between between, sort of secondary and tertiary markets, let's say. But what I would, and this is also, you have to remember, this is a little bit different from the investment cycle. This is really more focused on construction, but they're related because occupancy is really important to both of these analyses. But I think what you'll see is, let's just say you're like me, you're an investor who's focused on the upstate in South Carolina, which lies between Atlanta and Charlotte, right? I would say that there are probably very few big investors from Charlotte or Atlanta who are afraid to invest in the upstate and won't do it, right? So if they're looking for additional assets to buy and slightly better yield, you better believe that they're going to be going from Atlanta into the upstate or Charlotte into the upstate. So I think you can try to look at it that way too. Just in the way that now, in the old days, New York investors would never look in places like Atlanta or Charlotte, but now they do. Now they view those markets as, for some reason they view them as being incredibly risky, and now they realize that they're not. These are big markets, but you kind of have this effect of pushing down. The Charlotte, investors are going to Greenville. The Greenville investors are going to Anderson. I don't know where the Anderson investors are going, but you get that phenomenon. Right, it's a feedback loop. So this is where we start getting into the transition from market cycles to market psychology. So let's have the next slide here. Well, before we do that, go back to feedback loops. I want to explain what the idea of a feedback loop is. So a feedback loop is a psychological phenomenon where you have a group of people who are talking to each other, right? And they're in the same business, or they're in the same, could be really any kind of group, right? But they keep on cycling the same information to each other, right? And they feed off it. So what you see in the investment field is, investor one makes money, investor two sees that, he jumps in, investor three sees that, he jumps in, and before long you've got people piling into the market, and then they're all telling each other how great it is, and they all want to buy more and buy more and buy more. And that's generally the dynamic that's behind bubbles, right? This is how bubbles form. Even if they're not like major bubbles like the dot-com bubble or the bubble in 2006, pretty much any market ride up follows this phenomenon. And another book I'd like to recommend to all of you, which has really helped formulate my thinking a lot, is called Irrational Exuberance. It's a book by Robert Shiller, who won the Nobel Prize for economics. And you may know him because of the Case-Shiller Index, which follows housing throughout the country. But this book is not just focused on housing, it's focused also on the stock market. And essentially what his argument is in this book is that you really can't trace the market movements like at the top of the cycle to any real economic information. Like you can't tie it back to the news. You can't really tie it back to what's going on in the economy. The only thing that you can really tie it back to is these feedback loops of investors kind of essentially egging each other on, or people taking encouragement from what other people are doing. And now let's go to the next slide. And I want to kind of like paint a picture of what this looks like for you. But if you look at what's going on in sort of phase 4 and phase 1, this is when most investors are really scared to invest, right? They've seen the crash, they have a bad memory of the crash, and rather than thinking, wow, all the risk has now been removed from the market because we've fallen, they tend to think, oh, it's going to fall more because it fell, it's going to fall more, and they're afraid to move, even though this is when the assets are cheapest. So what happens is, this is when the really sophisticated investors come back into the market. So 16, 1, 2, 3, the really sophisticated investors are looking at the valuations now, and they're saying, wow, this stuff is really cheap. I understand how market cycles work. It's going to go up from here, so I'm buying now. Now, they may have the advantage of having access to cash, because debt is hard to come by at this phase of the market, right? So if you're looking ahead to this phase of the market, you want to be stockpiling cash. You want to be like making alliances with other investors who can move so you can go in at lower leverage or whatever, because this will be when it's hard to get debt. And that's why it's a great time to buy. What happens is as those early movers start to buy, sometimes it's referred to the smart money. When they start buying, other people start noticing this and they start coming in. So then the institutions kind of follow the smart money, right? They'll start buying. They see other people are moving and start buying. Then what happens when you kind of cross this line, right? Some of those early investors, the market's now moving. Some of them are talking about how much money they're making, or maybe they're even starting to sell and take profits. And when that starts happening, you pull in more investors. And the further up you go along this slope up towards 11, the more like skittish and nervous investors get pulled in. And the newbies get pulled in way at the top, right? Because they've been watching this process all along. And as people are making money going up this slope, psychologically what happens is they feel safer and safer and safer and to get in. And they also start feeling more anxiety about missing out. It's the fear of missing out, or FOMO, as you might hear it referred to. So they start coming in at this top part of the market without really understanding the fact that this is the most dangerous time to come in. They think it's safest. It feels the safest because they see other people making money, but it's actually the most dangerous time to come in. Why? Because there's only one way to go, and that's down, right? If you're lucky, it's going to hang around at the top. It's going to plateau for a while, but really, like, there's only one way to go from here. So, and this is when the people who got in down here at 1, 2, 3, they're selling assets like crazy to the people up at the top because they know that they can get really strong pricing up at the top. You know, the same asset, the same dollar they paid, maybe they paid 10 times, here they paid $100 to get $10 of income, or maybe just make it simpler. They paid $10 to get $1 of income down here at 1, 2, 3. And now up here, they're selling the same thing for $5. They can sell that dollar of income for $5 now. I mean, that's a cap rate, right? Down here, it's a 10 cap at the bottom, it's a 5 cap at the top, and they're working the cap rate. All right. So, but it's all because of this feedback loop, which we just talked about, as investors as they continue to talk about the market and pump each other up, and it feels safer and safer. You have to understand the feeling is different from the reality. So it feels safer the higher up you go until suddenly it stops being safe. And then the reverse happens. Then you get a negative feedback loop. And as people panic and start to sell, it causes more selling and it causes the crash, right? And meanwhile, the smart money is watching this at the same time, thinking like, okay, assets are getting cheaper. I'm going to get ready to get back in when I know it's cheap. Other people are feeling scared and they're selling and they're trying to get out. So that's why, typically whether it's stocks or whether it's real estate, it's often said, the amateurs buy high and sell low because they're getting in late and then they're panicking and selling at the bottom when they should just be holding. If they made the mistake of getting in at the top, the thing not to do is to sell at the bottom. Right? Just hold the thing, and the market will eventually bail you out if you're making your debt service. But I don't know. I think I've covered this topic. Anything you wanted to add on this, Dan? Or
no, I think that's great. I think you covered that very well. I've heard that kind of similar market cycle, explanation a couple of different ways. I think you hit it, very well there. The one thing I'll tell people who are watching us on Facebook, if you wouldn't mind making a comment or also liking the post, it helps kind of get it promoted. And for those of you who are on Zoom, if you will add any questions that you may have in the Q&A bar, that way towards the end we'll have plenty of time there for questions and answers. So this next section is all about the market psychology, and I want you to kind of get us started by talking to us a little bit about the market, about what is a cognitive bias.
Okay, so a cognitive bias, cognitive biases are we evolved to have cognitive biases because in general, they take complicated things and make them easier to understand, right? So for a lot of just like the way that humans act in the world, you don't need to have like complicated thinking because you have experience over time, and it's a shortcut, right? It's a heuristic, as they call it, that enables you to kind of like quickly react to a situation and just respond without having to think about it. The problem is that what happens though is that these kind of shortcuts, they can limit your thinking and they can get in the way of objective thinking, right? So because people tend to view the world through like their personal experiences and their preferences, those become shortcut in a much simpler time. Maybe they were fine, but they actually interfere with clear thinking. And, so they evolved to help people process vast amounts of information quickly. But the problem is that you create these rules for the way the world works, and they don't necessarily comport with the data, right? So the reason that this is so important to understand is because you have to understand how these cognitive biases work, because they will oftentimes be working against you in your investing, right? So the problem with them is that they feel right and they feel correct. So like I just explained, at the top of the market, when all these people have been pulled into the market, it feels very safe for them, right? Because they see other people doing that. There's a specific cognitive bias called the herd mentality that reinforces that. We'll hit that in a minute. But it feels safe. But if you look at that graph, you could tell that that's the worst time to be investing, right? And conversely, the bottom of the market feels really scary because you've just been through this crash. It's actually the best time to invest. So you need to be able to think your way around these biases, or understand that you have a bias, and that is going to help you invest better. And frankly, the greatest investors in the world do this. If you look at someone like a Warren Buffett, Warren Buffett is famous for saying, if you want to know how to get rich, I'll tell you the secret. Be greedy when other people are scared, and be scared when other people are greedy. This is him having understood how cognitive bias works in the market and doing the opposite, right? So you need to understand this to help you avoid bad decisions and to help you, understand speculative bubbles. And this is really the reason that as we said, people, if they don't know what they're doing, they buy high and they sell low. So I picked 11 of these that I think are most relevant to investors. And the first one is called confirmation bias. Oh, before we get to this, I just want to make sure that everybody knows everybody has cognitive bias. There's nobody who's immune to it, right? I have it. When we get to my particular one, I'm going to talk about it, but we all have them. So this has nothing to do with like how smart you are, how educated you are. We all have them. It's just human nature. You can't eliminate them, but you can push back against them. And that's what we're trying to do a little bit here. So the first one is confirmation bias. Now, confirmation bias is the natural tendency that we all have to seek out information that confirms our belief, right? We tend to filter out negative information or contrary information, and we only take in the information that supports our belief. And you see this everywhere around it. Particularly politics is a place where this happens all the time. Like people look for information that supports their political bias, and they filter out all the other information. And that's why it's very hard for people to like talk about politics these days, because they're only taking in the information that supports their point of view. In terms of like where you see this in investing, you see this when people ignore or explain away negative data about a property or about a market that they're committed to investing in. Like they want to invest in something, and you can tell them like, hey, it's not a good idea because of X, Y, and Z, and they'll explain away all that negative data. That's when you can tell that confirmation bias is working. So, for example, you might be talking to somebody who is committed to investing in a certain market because they see high cap rates, right? They see really high cap rates there. You might say, yeah, but the reason there's high cap rates there is because this place is losing, 5% of its population every year. And they just say, yeah, but if you every time you hear yeah, but, that confirmation bias is acting up, is acting. And then one last point in this, one tip off about confirmation bias: if you tell somebody some negative information and they react angrily to you, that's a sign that confirmation bias is present. Okay, next slide. So in-group bias or herd mentality, this is sort of confirmation bias that's applied to groups. So this is also known as groupthink. And it's kind of what we were talking about before with feedback loops. When you get a bunch of people together who are like-minded, they tend to keep on reinforcing each other by telling each other the same fact, the same stories over and over and over again. It reinforces their belief. It reinforces the story they're telling each other. And it creates a feedback loop. You can tell that this is going on when, members of the in-group often express anger at members of the out-group or people outside the group who tell them contrary information. So that's one way that you know that groupthink is going on, right? So let's say it's a bunch of real estate investors getting together talking about how great the market is, and you have someone come in who's like just invest in something else and has no knowledge about real estate and says, yeah, but look what I'm seeing here, and you all get angry and say, no, but real estate's the best thing ever. That's an indication that you've got herd mentality or in-group bias working. And a couple of examples from real estate, at least used to be, the institutional investors would only invest in the big six markets, in New York, Boston, San Francisco, LA, Washington, D.C., right? Because they thought everything else, they were just talking to each other about what was safe, and they didn't want to go outside those markets, right? So that was an example of groupthink. Or another example is during this upswing, something like, there were 12 submarkets in the entire country where most of the development was going on, at least for a time. So that's, everybody people are telling each other, this is safe, go here. They're seeing what other people are doing, and they're just following the crowd rather than exercising independent judgment or fact-based judgment. Okay, next slide. Bandwagon effect. So this is kind of similar to the last one, but the bandwagon effect is when people get comfort from seeing what other people are doing. So when we talked before about, you had different stages of investors coming in as they see what other people are doing, that's the bandwagon effect. So you get the smart money go in, the institutional money sees that, they go in, the small money, the sort of smaller investors see the institutional players go in, they follow, and then you've got the newbies following that. They feel safe because of that bandwagon effect. The bandwagon effect, you can tell it's operating when you have FOMO, right? When you got fear of missing out, that's when you've got the bandwagon effect at work, because people are afraid that if they don't get in on it now, they're going to miss their chance. Okay, Dan, next slide. Recency bias. Now, this is the tendency to overweight recent, really memorable information. So, it's the reason why, like, after 9/11, nobody wanted to get on a plane, because that event was recent in their minds and they felt scared, even though there was no additional risk, and probably less risk after 9/11 because every single plane had a federal marshal on it after that, and security went through the roof. So your risk was probably much lower, but people felt scared because of that recent event. And the same thing happens in markets, and you see this when, after a crash, when it's probably the best time to get into the market, people are scared because they have that memory of the crash. Or conversely, people may continue to invest in a market that was hot, even though it's past the peak, because they have that memory of it being a hot market in their minds. Okay, next one. Trend chasing bias. So this is the error of continuing to chase past performance in the mistaken belief that it's going to continue in the future. So, for instance, when people take those lists of like the top 10 hot markets and they say, I'm going to invest in these places because they're hot. And what they don't understand is that all of the data that went into compiling those lists is historically, it's looking backwards, right? It's not looking forward. And if you compare those lists from one year to the next, there's dramatic change, which suggests that there's just really no, they're completely useless, is the point. If you ever actually look at the lists, the top 10 lists from X publications, see what their top 10 list was last year. There might be some markets that are on there that overlap, but for the most part, you'll see like a whole set of new markets, because nobody can predict the future. So, following those trends doesn't make any sense. All right, next slide. Gambler's bias. This is a fun one. So this is the mistaken idea. Everybody knows with a coin flip, right? It's a 50-50 chance of getting heads or tails. But there's a bias where people think if the last one was tails, then the next one has to be heads, or the chances are higher that it's heads. And it's just not true. It's going to be 50-50 on every flip, no matter what. So, and it's worse when people think like, if you get 10 in a row that are tails, they think, oh, the next one has to be heads. The next one has to be heads because we had 10 in a row, and I know that it's a 50-50 chance. But the chance that 11th one is going to be tails is 50-50 again. There's no increased chances. Now, this happened, and a real estate example of this is when people think that, a property market is due for an upswing because it went down. I mean, even though, I don't want to ignore what I just said about markets having cycles, but, what people have to look at the data, right? So thinking that it has to go up just because it went down is a simplistic kind of gambler's bias. I think it's a better example rather than sort of a market cycle is, for instance, when I first got into this business, I started looking at this market called Newburgh, New York, which is on the Hudson River. It's about 60, 70 miles north of New York City. And all of those towns along the Hudson River between here and Albany, which is about 3 hours away, pretty much all of them have converted over to, they got deindustrialized, they went through a hard time, and they kind of reinvented themselves as like tourist destinations, weekend places to go, antiques markets, second home markets, things like that. And all of those towns basically got, gentrified over time, except for Newburgh, right? And the mistake I made early on was thinking, well, Newburgh has to be next. All the other ones have gentrified. Newburgh has got to be next because there's nowhere else to go. Well, 10 years later, it's just as big of a mess as it was 10 years ago. It hasn't improved. And that was my bias, the gambler's bias acting on me, right? So I wasn't looking at the data about how bad it was. I was just thinking it has to come up like the others. All right, anchoring. So anchoring is the tendency to rely too heavily on like a single piece of information when making further decisions. You get anchored into a belief, and then you think, and then it interferes with your thinking going forward. So a couple of examples of this. One is, let's just say you move from New York City, where it's going to cost you $1 million to buy a 2-bedroom apartment, right? And you move to Cincinnati, right? Where I don't know what the average cost of a 2-bedroom apartment there is, but let's just say it's $200,000, right? But you got your New York mindset because you're anchored to the price of New York. You go in there and you find a 2-bedroom for $500,000, and you're like, wow, what a bargain! This is great. I just saved myself $500,000, not realizing that you've overpaid by $300,000. That's the anchoring bias, and you see this happening, like for instance, people investing in Cleveland or Detroit because cap rates are high, and the problem is they're comparing it to the cap rate in New York City, right? Rather than to the historical cap rate within that market. They're anchoring to the wrong thing. You also see anchoring in, and this is one way to tell where you are in the market, is when you see broker packages, right? When it's a buyer's market, if you start seeing the way that you can tell it's a buyer's market is if you start seeing the offering being priced. If they start putting asking prices on, or you can tell that this is an asset that nobody's interested in, even in a seller's market. If there's a price on the asset in the offering package, they're trying to anchor you to the price. They want you to be thinking of that asset in terms of that price. They don't want to leave it to the market to price because the market may price it lower. They know that you're going to do your analysis, but they know that they can influence your decision by putting a price on it. Conversely, if it's a seller's market, they don't want to anchor you low. So they don't put a price on it. They say to be priced by market. And what they're hoping is that the frenzy will catch up and people will overpay, right? They don't want to accidentally anchor them to a lower price or, tip their hand and say we'd be willing to accept X because they might get a lot more. So either way, they're trying to, in a buyer's market, trying to anchor you to a higher price. In a seller's market, they're trying not to anchor you to a lower price. Right, next slide. So the bias towards stories over data. This is, humans, we live in stories. Everything is a story. We're telling ourselves stories all the time. Things are marketed by us telling stories to each other, right? It's how we relate to information. It's much easier to understand information in the context of a story than it is as data points. So this is why marketers try to engage us with stories about stuff and tell brand stories, right? It affects real estate in the following way. We tell each other stories like, for instance, a hot new hipster coffee shop opens up in some market and people start telling each other the story like, oh, or you tell yourself the story like, oh, gentrification is about to hit, right? I got to get in here because this coffee shop opened, a hipster coffee shop opened. It means the hipsters are moving in and I'm going to make money if I buy now. That may or may not be related to any actual data. You may still have population decline in that market. So you have to try to ignore the stories and focus on the data. All right. Next slide. Planning fallacy. So this is the tendency of people to underestimate the time, costs, and risks of future actions, to underestimate the cost and overestimate the benefits. And you see this especially with new investors who overestimate the money to be made and overestimate the ease with which money can be made in real estate, and underestimate the risk involved, right? So this is the kind of investor who says, oh, real estate's a passive investment, right? You just buy it and it makes money for you, right? It's easy to make money in real estate. Whenever you hear people saying that, or you think that yourself, you have this planning fallacy acting on you. So this is like, it should be a wake-up call. If you feel yourself starting to think, oh, this is easy, or I'm going to get rich this way, that's a signal that should be going off in your head and telling you, hey, no, wait, let me dig into the data, or let me talk to a more experienced investor about what's really involved here, or get some mentoring. Loss aversion. So I promised you that I would tell you the cognitive bias that acts on me the most, and this is the one that I have trouble with. So I'm conservative by nature, and I tend to overestimate the downside a lot of times. So I have to work on myself for this. But this is the bias that prevents you from taking action. This is the bias that, where you focus only on the losses and the risks, and you don't focus on the opposite. It's sort of like the opposite of the bias that we were just talking about, but you only focus on the downside. And it's related to confirmation bias in the sense that you're filtering out all the good information, and you're only paying attention to the negative information. Or this can be related to sometimes when people have like low self-esteem, they praise just like it doesn't, they don't even notice it, but blame like sticks to them, right? That's an example of the same kind of bias at work. And the way that this often comes up in real estate is if you're a new investor and you've had trouble with analysis paralysis or pulling the trigger, that's where this is coming up. It's your loss aversion is acting on you too much. Now, maybe you're actually looking at the data and you're making a real informed decision not to act because you see the downsides outweighing the upsides. That's fine. But when you find yourself in like that inability to move forward because you got to do another underwriting, or you need more information, or whatever it is, the loss aversion bias may be at act on you, and you should kind of try to rethink things and maybe try to look at the upside too. All right, next one. And the Dunning-Kruger effect. So this is the tendency that everybody has to overestimate our own abilities and skills. And it tends to, the people who are least skilled and least knowledgeable tend to overestimate their skills the most. So the flip side of this is often when you hear people say, the more I learn, the more I realize I didn't know. Right? You hear very experienced people who feel like the more experience they get, the less and less certain they get about anything, because they really understand things much more. They understand all of the different risks that are at play. But when people don't know much, they tend to fill it in with a story about how great it is, and they vastly overestimate their own abilities because they know the least. So, I talk to new investors sometimes who are just convinced of their own success. And, even though they've never done a deal in their lives, right? They've never actually been through this process once. They're convinced that they're going to succeed and it's going to be easy. The Dunning-Kruger effect is probably at work on these people. And as I said, like the flip side of this and the negative is when people say, the more you know, the more you know what you don't know, right? That's the opposite of this bias. So that covers the basic 11 that I picked. Once you understand that these biases exist, then it becomes very important to fight against them. But how do you do that? Right? How do you protect yourself as an investor against these cognitive biases? And the way that you do that is by having standards for yourself, by having investment criteria. And this is what you see big institutional players doing. They've got a set of criteria that they that they set up for investing, and they're not willing to deviate from them. And whether, usually it's a matrix of things. It's not just one thing, but it could be, certain class of asset, certain cap rate that they go in at, certain, certain percentage below market rent that they're buying at, certain neighborhoods, certain amenities in the neighborhood, whatever it is, a certain return on capital that they're shooting for, right? Whatever it is, you need to set up a matrix for yourself of investment criteria, like an investment checklist that you don't deviate from. Because the problem is, if you deviate from it, then you're going to be at the mercy of investor psychology, market psychology, the bandwagon effect, the in-group, the groupthink effect, the feedback loops. I mean, all that stuff is going to be acting on you, FOMO, because as soon as you get away from the data and your criteria, you've got no mooring in the world, right? You'll just do what people tell you to do. You'll go along with whatever sounds good. And that's a recipe for losing a lot of money. So the thing to do is come up with some rock solid criteria that you don't deviate from, and be willing to take your lumps, right? Especially at this point in the market, you have to be willing to forego deals that don't meet your criteria. Don't adjust your criteria to the deals. It's a recipe for disaster. And that's it. Thank you for the last slide. But so that's basically it in a nutshell. It's a very broad topic. As I said, if you want to delve deeper into this, I really recommend Thinking Fast and Slow by Daniel Kahneman, and Irrational Exuberance by Schiller, Robert Schiller.
Yeah, and I'll make sure that when I send out the recording, that I'll include those links to those various books and resources, and even some of the websites that we mentioned. I have a couple of questions, if you have a little more time, Jonathan, to go that a couple of people have asked. I know there's been one or two on the Facebook platform, and then there's right now there's three of them on the Q&A for the Zoom platform. So
yeah, have a few minutes. I've got time. Happy to answer any questions. Before we do, I just wanted to make a couple last points about protecting yourself from cognitive bias. So in addition to having criteria, a couple of things I left out that are in my notes I think are really important. Look for data that contradicts your story that you're telling yourself. That's a really important thing to do. So you've got your criteria. Look for the contrary data. Challenge your thinking at all times. But also, a really good one is to work with partners who have the opposite bias of you or have different biases, right? So if you know that you're like overly pessimistic, find a partner who's really optimistic, right? And you can come to a happy medium. It helps you bust out of your thinking to be around people who are not thinking the same way. So just wanted to make those last points. But yeah, so any questions?
Those are great points too.
Any questions that you have, I'm happy to try to answer.
So I'll go ahead and ask these questions to you, and you can answer them as we go throughout. This first one is from Shavesh. He says, could you please give me an example of any city that moved from phase 3 back into phase 2, and what drove that shift?
So I don't have any examples of that. What I've seen is markets that went from, say, like 0.14 or 13, or so like 13 or 12 back to 11. So they just moved back a couple of notches back to the peak. But I think just sort of thinking out the question, what would have to happen, it's all about supply and demand, right? So either new supply would just dry up, right, while there was still growth, right? So before the cycle ran its course, if for some reason new supply in the market just stopped, but you still had economic growth, that would tip the supply-demand balance back so that you still had very strong rent growth, right? And you'd go back into phase 2, which would be expansion. Now, at least in theory, that would pull more supply into the market and correct itself. But that's how that would happen. Or, let's say the economy could improve so much that the demand outstrips the supply by a really big margin. Now, do I think that would happen? I mean, right now we're like historically low unemployment. There's nowhere for it to go but down. Like, we're essentially frictional unemployment right now, which means that like basically it's the unemployment that people have in that short stint between jobs. So looking for markets where it's going to tip back into 2, I think, is kind of a fool's errand. I don't think it's going to happen. I think it's much more likely we're going to tip over some, rising interest rates or something is going to cause the economy to slow down, and on the other end of things, not tipping back into 2. But just remember, 4 is where you want to be. You don't want to be in 2. You don't want to be buying in 2. You want to be buying in 4. You want to be buying in 1, right? That's where the value is. That's where you're going to make your money. So
the next question is going back to, I believe, this slide here. Yeah. So I just want to have it up while I ask you this question, Jonathan. So the question is from Shankar, and he says, you showed Las Vegas, Orlando, and Jacksonville to be an expansion phase. Where in the stage 6 to 11 are these markets today?
No. So you're misunderstanding. See the line that goes to 11? This is actually showing that they're all at point 11. So point 11, I'm not really sure exactly why. If you look at earlier versions of this graph, this line between phase 3 and phase 4, between phase 2 and phase 3 runs right through 11. 11 is the peak, and all of these markets are on this line to 11. They're not at various points in phase 2. They're all at the top of the market. That's what this is showing. So if you look at these other, I guess it's a little bit hard to read, but if you look at point 12, all of these markets between Boston and Washington, D.C. are all in 12, and Atlanta through Palm Beach are in 13, Oklahoma is in 14. Now let me point out one thing, since we do have the slide here. If you notice that some of these markets, they'll have like a +2 or a -1 next to them. So if you look at Detroit here, which is up in the green area, it says -2. So what that actually means is that Detroit was at 13 and it moved back up to 11, right? Similarly, if you look here in phase 3, Honolulu is +1. That means that since the last report, the previous quarter, it moved from 11 to 12, right? Miami, Milwaukee, so Miami, Philadelphia, Portland, they all moved from 13 to 12 since the last one. So they moved back up a little bit. So there is some movement, but everyone else looks like they're stable. They've been like New York, New Jersey, they've been sitting at 11 for a long time. Boston's been sitting at 12. These southern markets down here, except for Denver, I guess, have been sitting at 13, at least since the last report. So, and again, this is the second quarter, remind you. So this is the snapshot in July. If you want to get the snapshot of September, you got to wait till December to get that one.
So one of the other follow-up questions to this, Jonathan, about, there's one of the gentlemen in here pointed out that Atlanta right now on this graph is in phase 3, that the hyper supply. Why is everyone today highly recommending to go invest in Atlanta?
So remember when I talked about, let's see, which bias is that? That's the recency bias, right? Atlanta's been hot for a long time, and so people think it's still good, or they think it's a good market, but they're still anchored to the past, right? The other thing is, just as I explained when we went through the phases, and maybe you missed this, but this is important, it's worth reiterating. Dr. Mueller actually, if you download this whole report, he actually describes the phases in a lot of detail. And one of the things that he talks about, which is very interesting, is that people usually miss phase 3. And the reason they miss it is because you're still having rent growth in phase 3, right? It's just the rent growth is decelerating. So if people are looking at the rent growth and they're saying, well, look, Atlanta's still growing, 2% a year for rent growth. It's a strong market. It really depends on what the trend is, because if it's trended down from 5 to 2, that means that there's a lot of supply coming on and that you're likely to keep on going down this slope. So it's really important to get a hand on the data. And again, we're talking like feedback loops. We're talking stories that we tell each other about where to invest. People are saying is a great that should be a trigger to you that's based on nothing, right? It's just people are saying. Which people? Who said it? Based on what? Based on what someone else told them, most likely. You want to dig into the data and ignore all that stuff. I mean, the secret to being a really good investor is to just be focused on the data. Focus on data.
Well, one of the things I wanted to ask you, and kind of a follow-up to this, is, didn't you mention that this is a graph based on the based on the amount of, what you didn't say, it wasn't an investor, kind of cycle. It was more of, new construction on apartments.
It's based on supply and demand for apartments, which is obviously influenced by the amount of new construction.
Sure.
Right? But so they're not, I think it's a good point you make. Like they're not, the market for existing product is slightly different than what's going on here, but they're really related in the sense that if there's a lot of new supply in the market, it's going to trickle down into other asset classes at some point. If there's enough of it, certainly it will. But it also tends to influence how the banks are thinking about lending, just the supply of available money for real estate in general, like how people are thinking about the market. So they're not exactly correlated, but there's I think a pretty strong correlation between the two, right? So, if there's, for instance, a lot of supply in the market, when you're going to get a loan, you may find the lenders to be less interested in that market, right? And you may be able to make the argument to them, well, look, A class has got a glut, but C is rocking, and you should still invest in this. You may be able to convince them, but I think it's going to, the lenders are human beings too, right? And they're subject to all of this stuff, and they may get scared if they see occupancy going up too much in a particular market. And you always have to be wary of that. I mean, the last thing you want is to be like owning a B property and have an A going next door that can't fill up. And then they start offering, huge concessions and pulling all your B tenants out of there. And then the B tenants are, going over and trying to poach the C tenants. The B properties are poaching the C. Mm-hmm. So they're related to each other. It's not a perfect correlation, but they're not unrelated. And I think people sometimes talk about them as if they're like silos that have no connection to each other. They are related. The correlation may not be, it's definitely not one-to-one, but they're not unrelated to each other.
So another question along this kind of same line where we have this graph up is, how will the quantitative restriction and rising interest rates shift markets along that curve faster than they might otherwise move?
So I think that's actually different. Well, okay. So it's good. Actually, this is a good question that you asked, because I think then this is where you cause like the two different markets to perhaps move in different ways, right? The investment market and the new construction market. Because if interest rates are rising, it's going to make it so banks are going to lend less for a certain price, right? So you're going to get less proceeds, you're going to get less LTV on a purchase, right? So it's going to cause cap rates to go up eventually on the purchase side. On the other hand, though, it may also cause construction to slow down, right? The higher interest rates go, the more expensive it is to build. That's going to cause the new supply, or the rate of growth to drop, right? So your supply issues may kind of solve themselves, And then the third thing, though, to throw into all this is if interest rates rise too much, it'll cause an economic slowdown, which then is going to hit the demand side, right? So I think like overall, even though I think there's people out there saying like, oh, if interest rates cause this new supply to slow down, it's good for apartments. That interest rate rises are also going to cause the general economy to slow down, which is bad for apartments. So it's probably a wash. I'm not sure which effect is going to be stronger.
Mm-hmm. So the next question here is it possible that these markets that are in phase 1 and 4 are entirely different than with what the national trend is?
I suppose it's possible for them to be really out of phase, but it's just a little bit hard for me to imagine. Like I would have to see it to believe it, I guess. The reason I'm skeptical about it again is because of the supply of money in the system and the chase for yield.
Mm-hmm.
Right? So, and people have really overcome a lot of their biases about investing away from home, and even the smaller investors, right? I mean, it used to be the common knowledge, the received knowledge of real estate investing, if you were on the smaller end of things, was, oh, you should only invest in your backyard. You should never invest away from home because something terrible could happen and you wouldn't know. But I think because of technology, because of the growth of sophistication of the industry, because of just more information out there, like what we're doing right now, the fear of investing far from home has really lessened a lot and made it more of a national market. So, as I said before, I think you see some lags, but I think you also see, so for instance, people going into markets like Detroit or Cleveland or Buffalo or things like that. They're looking at it on a cap rate basis because they have, they're comparing it to the markets that they're living in. The fact that the cap rates are higher there, I don't think necessarily means they're in a different phase, though. It just means, because you can only compare the markets themselves. You can only compare a Detroit cap rate to a Detroit cap rate. You can't compare it to a New York City cap rate. It doesn't really, it's comparing apples to bananas, right? So, but you have that phenomenon where there is New York money chasing Detroit houses because of because of that chase for yield. I just sort of thought of one other thing to add to this, though, in terms of like, could there be markets that are in different phases? And I suppose, oh yeah, actually, I did want to say this when this sort of question came up before. I think you're more likely to see this early on in a recovery, right? Because the recovery is going to, if we have like a national recession, there'll be some markets that won't be hit that hard. There'll be some markets that will emerge faster. So I think when we have a correction, you'll see more variation in where cities fall on this graph, because some will get out of the gate faster. Some may have had structural changes to their economy that make it very difficult to emerge from the recession, and so things will just happen more slowly. At this stage of the market, though, where we've had 10 years of expansion, we've had 10 years of loose money, we've had 10 years of the real estate market expanding, there's a lot of sort of confluence of these markets as people have chased yield over time, right? So I think there's much less I just would be very surprised to find a market that is like truly in like phase one now, when everything else is in phase, the top of phase two and into phase three. And if you did, my fear for that market would be that, if it's someplace that's super depressed, right? And it's only just starting to emerge now, it might, the recovery might be stunted when the national economy finally tips over into recession. It just might not ever really get out of the blocks. But, that being said, your risk is probably fairly low because you're investing in a place that's kind of depressed already.
Well, I have one more question that we'll wrap it up with, and my screen just kind of went out here. But
yeah, you look good now.
Yeah, I think we're good. We just have our video here, which is fine. So the last question here is about, it seems like that graph is more for the A class and possibly the B class. How does that kind of graph factor with the C class sector?
So again, like I said, I think it's related, right? I think that in terms of like the supply and demand dynamic, there are different, obviously between B and C, there's overlap. Between A and B, there's overlap. There's no direct competition between A and C, but you will have this kind of like filtering effect. I think that those like A, B, and C class properties, if you look at the cap rates, they move in tandem, right? They may be different markets, like they may have different investors who are interested in each class, but the trend is the same over time, right? When you see compression happening, the next level has compression, and the next level has compression too. It's not like the class A has a really high rate of compression and the others, well, they might have, I'm going to take that back. They may have differing rates of compression, but the trend is going to be the same, right? So you won't find the one lagging. It's not like C is going to be in phase one and A is going to be in phase, in phase three. but they trend together. They trend through the cycle together. Cap rate trends are similar, so if you see the time series for cap rates for, I haven't seen this recently, but like Marcus and Millichap used to put this out 5 years ago, where they would show this graph of cap rate trends over the last several years. And you could see A, B, and C, they moved together. There was a difference. There was basically like a point of difference from A to B and from B to C, but they were going like this, together through the time series. So because they're related to each other.
Yeah. Well, Jonathan, I want to thank you very much for joining us on the Multifamily Investor Nation webinar. You have been wonderful, answered a lot of my questions. And I know a lot of the people that have joined us have learned quite a bit. I know you might still have some more questions. I'm going to send out an email with a link to the recording. And for those of you who have further questions, you can either on Facebook make a comment and tag Jonathan on, and he's part of our Multifamily Investor Nation group, so you can jump on there and answer any questions as he sees fit. And you can also, if you're watching this on YouTube, you can ask your questions in the comments, and we'll be glad to answer those questions as possible. So again, thank you so much for being with us today, Jonathan, and look forward to having you on a future webinar.
Absolutely. I had fun today. Thanks a lot for having me.
You're welcome. Bye.